There has been a lot of interest and discussion in the real estate sector about the concept which is typically referred to as fund of funds. So this is typically when you create an entity, some people refer to this as a special purpose vehicle or SPV, you create an LLC, pool investors together, and the intention of that LLC or that special purpose vehicle is to invest in another person's deal. Now, I know it can be a little bit complicated because people hear the term fund and it implies a lot of things, but please just remove that for the purpose of this conversation. I'm not talking about multiple properties. I'm not talking about multiple investments. Let's just use this term special purpose vehicle to avoid some of that confusion. I'll explain how the term fund of funds kind of applies to this, but typically speaking, people use those terms interchangeably. Let's not go down that rabbit hole. We'll use the term special purpose vehicle. Typically, the structure is called fund of funds. For what reason, I don't know. Now, why would people do this? So one of the reasons that people would do this is that they want to derive their compensation for raising money, for pooling investors together, for administering and making this investment opportunity possible. They want to derive that compensation at that entity level. They want to be able to create an entity and for them to compensate themselves for administering and making this investment opportunity possible. They are the sponsor of that special purpose vehicle, even though that special purpose vehicle's only intention is to invest in passive ownership of another person's deal, a sponsor's deal. Now, the reason that they would want to do this, there's many. One of which, probably the most common, is that this is how you can be compensated without being a third party. In the world of real estate, in the world of securities, you don't want to be compensated for raising money by a sponsor if you're a third party. Now, the two easiest ways to overcome that is you can be a sponsor, and therefore, again, you're compensating yourself, or you can create your own special purpose vehicle, and as opposed to the sponsor paying you, the investors pay you directly. So you are the issuer of that security. You're not a unrelated third party. Now, another reason you may create a special purpose vehicle is you want quality control. You want to be able to be the one issuing the distributions. You want to be the one that is issuing the quarterly reports, and your investors are directly interfacing with you as opposed to you referring your investors over to someone else. So those are a couple of reasons why people would create this special purpose vehicle and then invest passively. Now, when you do this, though, there's obviously an extra layer there in the sense that you have a passive investment at the property level that's being paid to the special purpose vehicle. And that special purpose vehicle then is an intermediary between the investors and the property. So why would someone invest through a special purpose vehicle? Well, there's a lot of reasons. The most important is that the investors don't have access to the deal otherwise, but even so, you can make up for those economics in a lot of ways. One of which is you can go to the sponsor and say, look, we're not going to be investing $50,000 or $75,000. I'm pooling 10 investors together, and cumulatively, we're going to be investing $500,000. Now, given that's about 10 times your normal investment amount, can you create a special class of shares so that my special purpose vehicle gets preferential treatment and perhaps gets a higher preferred return, perhaps gets a more favorable split above the preferred return? Because I'm going to be handling all of these, the administration of this entity. I'm also going to be investing quite significantly. So I think it would make sense that my entity should be treated preferentially. Now, the sponsor may say, well, I don't really care much about $500,000. We have $150 million in equity that we're deploying right now. That would be a very large sponsor, but there's a lot of sponsors out there that $500,000 would be really, really meaningful. So you can leverage the ability that you can invest significantly to get preferential treatment. Now, an important distinction is that that preferential treatment is giving itself to that investing entity, right? Not the unrelated third party. So that can make up for some of the economics, meaning that if you get, let's say the normal deal is an 8% preferred return with a 50-50 split. Well, if you're investing $500,000 or $1 million, maybe you get a 9% preferred return with a 60-40 split or a 65-35 split. That is more favorable for your entity. So, again, just using that same example, if you have that entity, rather than pass through 100% of the proceeds to investors at the special purpose vehicle level, you could have an additional 95-5 split. Now, if you're able to negotiate favorably with the sponsor, that 95-5 split may still mean that your investors are getting the same economics as if they invested directly, but they get to rely on your expertise. They get to deal directly with you. They get to know that they're not circumventing you because there's no reason to do that. And they can rely on your deal flow in the future. Now, of course, if they do try to circumvent you, you don't have to pursue them financially. You can just say, well, we've removed you from the investor list, and that's the end of the relationship. And of course, you can get them to sign things like NDAs and stuff, but it's not really cost effective to pursue people like that. So I just try to make the economics as favorable as possible if I'm going to utilize this structure. So again, that's a really popular way that a lot of people start their business of raising money, because it doesn't require much other than just going out to your friends and family, getting 10 investors, each investing $50,000. Now all of a sudden you have $500,000 you can invest, and you can invest that into another person's deal. You don't have to be a sponsor in that instance. In the property level, you are a sponsor of your special purpose vehicle, but that doesn't mean you have to go out and establish all the relationships and interface directly with brokers and identify a market and be best in class in your particular niche in order to actually have success in this industry. This is actually how I created, the first offering that I did many, many years ago. So again, when people see the structure, they can be turned off by the fact that there clearly is an intermediary in between them and the property, but you can overcome this by negotiating with the sponsor. You can also overcome this by saying, look, I have done a tremendous amount of due diligence. I have vetted this sponsor. I have flown around the country looking at their properties, and I know a lot about real estate, and I'm providing access to a deal that you wouldn't otherwise have. Sure, you can circumvent me, but that'll end the relationship. And by the way, we're able to negotiate favorable terms for our entity so that you're not incentivized to do that. It's a very, very powerful concept. Now, there are some challenges with this structure. One of which is that because you are a special purpose vehicle, an SPV, you will need to first receive a K-1 document and then repurpose that document to your 10 investors in this example. This can be very challenging when it comes to the timeline of tax documents, because a lot of sponsors push it to the very last day. And then to be able to turn it around very quickly, it's administratively very burdensome and can be really a headache. And I have had many sleepless nights when it gets down to crunch time, because we want to provide a really quality experience to our investors, and many of them are not used to extending their tax returns. Now, that's a metaphor for a lot of things, right? You have to first receive the distribution to then turn them around. So everything is going to be delayed a little bit from a timing standpoint. And administratively, this can be a little bit burdensome and challenging. So what I would suggest you do if you're doing this, I would suggest creating a timeline which is conservative, so that more than anything, your investors in your special purpose vehicle can have a reliable cadence to when they should expect to receive distributions and tax documents and quarterly reports, etc. Because the reliability of that is absolutely critical. And there's other things that you'll have to learn along the way, but I'm a big proponent of the fund of funds model, even though I know that term is confusing. So let's just say again, the special purpose vehicle, which special purpose is to invest into another deal. Now, without getting too confusing, I will say that just because you're creating a special purpose vehicle does not mean that that entity can only invest into one offering. If you draft your legal documents as such, that special purpose vehicle could invest into multiple different offerings. And this is where the term fund kind of has two meanings. In this instance, most people would consider that a fund because there are multiple properties or multiple investments. And then you get into a very complicated world of asking many, many questions about how to accept investor capital, when to accept investor capital, what happens if you accept a lot of capital and don't have a deal, do you pay them an interest rate? If you so, how much? There's endless questions that I have spent no less than $100,000 contemplating and actually drafting documents myself, and with the help of my lovely securities attorney, Peter Fisher over at Sklar Kirsch. I did an episode about fund mechanics and why they matter. We'll link to that in the show notes page. And I know sometimes I say we'll do that. I'm done with that. Sometimes we say we're going to link to something and we don't do it. I'm over that. We have a system now for doing it. This will 100% be there. So I hope that clears up a lot of questions about fund to funds and special purpose vehicles, why people do them, how you can overcome some of those challenges, how you can negotiate with the sponsor, and some of the caution about what you may have in terms of some headwinds when you do create a special purpose vehicle. All right, hope that helps. All right, listeners, you know the routine. This show is all about learning, making wise investments, and protecting and growing your capital. So if you're interested in these topics, make sure to hit the subscribe button. Of course, if you've already enjoyed a couple of great episodes, don't be shy, leave a review. It really helps the show's visibility. And lastly, if you're an accredited investor and you're interested in learning more about our investment opportunities, the types of deals that I personally invest in, go to asymcapital.com. That's ASYMcapital.com. Thanks a lot.